Hello, my name is Christina Kavanaugh, Operations Manager with Visions Investment Services, and welcome to our Women in Wealth seminar, Investing, Why You Are Worth the Risk. Today, we're going to take a deeper dive into risk tolerance and how this could impact your financial future. I'm excited to introduce our presenters today and some of our financial advisors. We have Marcy Depew, Jerry Harrison, Krista Perry, and Candace Chapman. Now, let's get into it. Marcy, turning it right over to you.
Thanks for the intro, Christina. Today, some of the topics we will discuss are understanding market movements, volatility, it's normal, taking a longer view, compounding and how it works, diversification benefits, investments, how they should align with our goals, the importance of rebalancing. Understanding risk is critical. You control your emotions and behavior, and realizing the benefits of working with a professional. So now we're going to take a look at negative market headlines and how they can create panic. It's hard to stay calm when we're bombarded with news about the economy and the markets. We receive a greater amount of information faster than ever before, which can lead to more noise and more fear about the markets. Anxiety about your portfolio can creep in, and before you know it, a media barrage may turn your anxiety into panic. And if that's not enough, investing has become more complex, pushing investors to take on more risk to achieve the same return they did maybe 10 or 20 years ago. So how do you keep calm with market volatility and when it heats up? In the past few years, we have seen a lot of market volatility. While a decline may seem daunting and unsettling, it's important to remember that market movement is inevitable and completely normal. Time after time, the stock market has recovered from disruptive but ultimately short-term declines and has gone up to post gains. Markets are always moving. They rarely go straight up. Over time, stock markets have moved higher, bouncing back from short declines. It's important to keep in mind that if you sell when the market falls, you'll likely miss a rebound and any subsequent gains, possibly falling short of your goals. So we need to understand that risk is critical. While we can't avoid risk, by understanding its nature, we'll be able to manage it. Managing the downside is just as important as capturing the upside. Determining the risk in your portfolio may make the difference while pursuing your goals. And keep in mind that a long-term perspective helps distinguish real risk from short-term noise. I'm now going to turn the program over to Jerry Harrison, and she's going to cover balancing types of investments. Thank you.
Hi, thanks Marcy for that introduction. Balancing investment types. So if you were at our February seminar, we talked about stocks, bonds, cash. And that's kind of the different investment types that we're talking about. We're going to concentrate on here for a minute, looking in terms of volatility, looking in terms of risk tolerance. So if you look at this triangle, at the bottom of it is your stocks, coming up to bonds, coming up to cash. Every person who's investing should have investments in all three of these areas. What changes and adjusts is depending upon your age, your risk tolerance, and things like that. If you are that nervous Nilly, you're probably going to be a little bit more in cash and bonds. You're going to want to stay in those because that's kind of like riding the baby roller coaster if you're at an amusement park. On the other hand, if you're young or you consider yourself a more aggressive investor, you're going to be more looking at riding, you want to be riding the Superman. You want to be going up and down and all over the place. You might be that person who chases the hot stocks. There are a lot of reasons though, and Candace is going to really concentrate on emotional investing later on, and that's really part of what you have to look at. Am I willing to accept that downturn? Am I willing to say, I have a tolerance if my portfolio were to drop 15% or 20% because I'm 100% in stocks and I'm 100% in more aggressive stocks, those smaller company stocks, those mid-company stocks as opposed to the larger. I'm willing to do that. Am I willing to accept the risk of that? Or if I open that statement and oops, my account is down 25%, am I calling, oh, I gotta go to cash, I gotta go to cash? If that's what you're doing, you're not taking the long view. You're looking very short term. And study after study after study shows that if you go try and time the market, and the minute the stocks go down, you come back out into cash, and then they start going up, you're never quite sure, do I get back in? When do I get back in? All of that comes into play in looking at your risk tolerance. So one of the things that you need to decide as we look at looking at longer frames of investments, where am I? Am I that nervous Nelly? Maybe I'm just riding the train around the park. I won't even get on the baby roller coaster. Or maybe I'm willing to try the adult roller coaster. And maybe I'm going to ride the baby roller coaster 5 times, but only ride the adult roller coaster once, however that works. So depending upon where you're willing to do your risk tolerance, what you're willing to accept, you're either going to be a conservative investor, maybe a moderate conservative, a moderate aggressive, or an aggressive. And all of those we've seen in history have different average rates of return. So maybe if you're that really conservative investment, that 3% rate of return works for you. So if I start out in 3% with $10,000, it's going to take me about 40 years then to get to that $136,000 that shows there. If I'm a little bit more willing to take a little bit more risk, a little bit more tolerance I have for that, then I'm willing to go and maybe I'm going to earn an overall 5% rate of return. If I'm willing to be even a little bit more aggressive, it's the average. Now, one of the things that this slide needs to really highlight on this, when you look at this slide, it looks like it's kind of just an overall up, 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 depending upon which section you're in terms of conservative, moderate, or aggressive. The slope of the line is steeper. However, in reality, we all know it's not a straight line up. So in reality, all of these lines are doing this, but the overall trend is in that direction. So you do have to understand that, and you have to work with your emotions, and you have to work and look at your risk tolerance to see what you're willing to accept and willing not to get frightened and bow out at inappropriate times. One of the rules that I learned a long, long time ago, I quote this all the time, the rule of 72. So this can help you in terms of what am I willing to accept? Because what do I need to achieve in order to get where I want to be? So if you're that nervous Nelly that's going to sit in a cash account and earn 3% rate of return, the way you look at the rule of 72 is take 72, divide it by that rate of return, and it tells you how quickly your money's going to double. So at 72 divided by 3, it's going to take 24 years for my income to double. That means in order for me to have enough in retirement, I have to save a lot more because my money's not working as hard for me as if I'm willing to accept a little bit more risk. So then if you go and you look at that, let's say I'm willing to earn and be aggressive enough to earn an 8% rate of return on average. 72 divided by 8 says my money will double every 9 years. So a couple of different ways to look at this is, what is my time horizon? You know, am I 20 years old and I'm thinking I'm going to retire at 65 and 45 years? Or am I 50 years old and I'm thinking I'm going to retire in 15? And so then if you really want to think about, am I saving enough money for retirement? If that rule of 72 says my money, whatever that is, my $50,000 is going to double only once, now I got $100,000. Is that really enough for me in retirement? Probably not, but certainly those are things that we want to look at. The other piece that I like to look at in the rule of 72, And this is the piece that I point out in terms of people trying to understand inflation. So if you take that 72, historically inflation has been about 3%. So go back to 72 divided by 3 says every 24 years the cost of living doubles. So the $3.50 gallon of gas right now, in roughly 20-25 years, if we were at 3% inflation, is now going to cost us $7. We're all complaining about the price of eggs being $5 right now. Well, that says in 25 years, they're now going to be $10. Your investments and your ability to accept risk has got to come into play in terms of, is my investments keeping up with inflation, as well as, is it going to keep up with taxes? So those are the two things that, while you might want to pull back and go with a really low risk level, we have to give consideration to what's going to happen with my money, and am I going to have enough money to retire? How often do everybody say, oh, I'm never going to be able to retire? Well, we want to work so that you can retire when you want to retire. So just as important as looking at the long view and looking at your risk tolerance is also considering how are you investing that money. We look at dollar cost averaging in order to be able to kind of minimize the volatility. I don't want to buy on a day when everything is high. We'd all love to buy on a day when everything is at its low, but we never know when that is. So dollar cost averaging gives us the opportunities to do that. So in the example here, if I wanted to invest $1,200 and I invested $100 every month on the particular day that's noted there, in the end, I would end up with 575 shares at $2 each. Kind of what we do when we purchase money, when we have money taken out of a paycheck in our 401k. We're putting money in every week or every 2 weeks, however that goes. On the other hand, if I looked at a day when it was low, if I happened to, I was able to buy in April, and I was able to buy at $2 a share, my $1,200 would now buy me 600 shares, which is great. I'd love to do that. But do I know that the April number is going to be the low number of the year? No, it's great to look back. I can't necessarily see that. None of us are fortune tellers. None of us have the crystal balls. If, on the other hand, I looked at purchasing that all in October, well, now it's at the high, so I actually only end up with 300 shares. So that dollar cost averaging gives me the opportunity. I'm going to buy more shares when the price is lower. I'm going to buy less shares when the price is higher, but I don't have to worry about what it's doing. So that automatic investing, that pay yourself first, whether that's money being deducted out of your 401k, whether that's doing a monthly dollar amount into your IRA or into another type of investment account, when it's automatic, you're really doing that dollar cost averaging, which gives you the opportunity to get some at those higher prices, some at those lower prices, and average out, hopefully, to a much better rate of return in the end. When we look at stocks, again, combine the dollar cost averaging. So if you're that 20-year-old, if you're that 25-year-old, now I've got that 40 years, and I'm doing the dollar cost averaging, and I can watch my money double. How much difference does that make versus I plopped in $50,000 once, and maybe the market was at a high, and I didn't have the opportunity to buy in more shares? I've been talking with a lot of clients right now, with the market being so low, don't look at the value of your portfolio right now because it freaks people out, but look at how many more shares you get to buy now, because the share price is compressed at the moment. That means when the share price starts coming back up, because you own more shares, you're going to see a bigger mushroom than you would if you had to only buy shares at the high level at all points in time. Ideally, what you really want is you want the market to stay down until about a month before you retire and then go like this, because then you've bought a lot of shares and now you're making a lot of money. But we all know that we can't time it that way. So the dollar cost averaging helps in that, in terms of making sure we're buying as many shares as we can without having to worry about timing the market. And when you look at stocks over that long haul, you are ending up in a positive return if you stay in for that long time. So dollar cost average for 10 years, for 20 years, for 30 years, looking at this rolling 20-year period, even when we're all talking about how bad the market did in 2022, if you look at the 20-year period from 2022 back to 2002, overall that was still a positive rate of return. So if you got out of the market and into the market at different points in time, rather than staying invested throughout all of that roller coaster, you're potentially not going to have that positive rate of return. Staying in and staying in for the long haul is really where you're probably going to get your best overall achievement of the goals that you're looking for. Diversification certainly helps in all of that, and that's where Krista's going to come up and explain what that's all about.
Thank you, Jerry, for that important information. So now we're going to talk a little bit about markets, and it's important to remember that markets changed. And Marcy touched on this as well as Jerry. They fluctuate up and down, and investments that performed strongly one day, 1 month, 1 year, or 1 decade ago may not do as well in the next. The asset class with the best performances change from year to year and decade to decade. Trying to consistently pick the best performing asset is almost impossible, especially as emotions get involved. And Candace is going to hit on that. Diversification spreads your investments between multiple asset classes that all perform differently. Potentially, strength in one asset class can help offset the weakness in another. In down markets, diversification may help your portfolio lose less value than the market. In up markets, diversification can help your portfolio take part in those market gains. Looking at a long-term perspective rather than short-term, performances show how diversification can help your portfolio navigate volatility and potentially get you closer to your goals. Over time, your focus as an investor likely shifts from growing your portfolio to preserving it, right? Well, when you're in your 20s, you have what seems like a lifetime to achieve your goals, and you have time to take more risk. But by the time you reach your 50s and retirement is looming, taking too much risk isn't always the best course of action. Consider aligning your asset allocation with your goals. Equities for growth and bonds for income and risk mitigation. Determining how much money you choose to withdraw annually when retired is equally as important. A high withdrawal rate may mean that you outlive your savings, and none of us want that. This graph demonstrates that the chances of your retirement savings payout lasting 30 years or more decreases with a higher withdrawal rate. Conversely, your chances of that payout lasting 30 years or more increases with a lower withdrawal rate. Now keep in mind, asset allocation does not ensure a profit, and it does not protect against a loss. Over the course of your lifetime, your goals change. Your risk tolerance may need to adjust. To stay in line and keep you on track, it is important to consider rebalancing your portfolio. As you get closer to retirement age, the portfolio you created at the beginning of your savings journey could be considered too risky and result in too much of a loss in value should the market fall. As a reaction to change in risk tolerance, you must, or well, you might, want to rebalance and reallocate, moving out of stock and into fixed income options. The slide here shows an original allocation of 50-50. 50% stocks, 50% bonds. Well, in the time from January 1 of 2013 to December 31st of 2022, stocks performed well. So as of 12/31/2022, your allocations are now 75% stock and 25% bonds. Well, now you're 10 years older. Is that too risky for you? Only you can determine that, but by moving the growth of 25% stocks to bonds, you are bringing your portfolio back to its original allocation of 50% stocks and 50% bonds. Now consider this. How many of you have a 401k or other retirement plan? Okay. Well, how many of you rebalance your allocations? For those of you who have, congratulations. For those of you who haven't, do your current allocations, which have now shifted because of market change, fit your goals? Chances are they may not. So I suggest picking a date. Could be any date, an anniversary, a birthday, a holiday, whatever works for you. And use that as a guide every year to make sure that you're going in and rebalancing or looking at your retirement plan, your portfolio. My best friend used my daughter's birthday. It worked for her. It worked for her in remembering to go in and do those changes. But even if you choose to change your original allocations, rebalancing is critical to help you achieve your goals and at least keep you aware of what is going on in those retirement accounts. Thank you. I'm going to turn everything over now to Candace, and she's going to talk about risk and the emotions that are attached to it.
Thank you, Krista. So what is risk? Well, risk is the possibility that something bad or unpleasant will happen, such as loss or injury. Now, all investments have the risk of loss. So it's very important for us as advisors to understand our clients' risk tolerance. And one way we do that is by asking them to fill out a risk tolerance questionnaire. If you do one of those, you're given a score, and then that helps us to understand your comfort level with risk, but also the types of investments that fit with your objectives. So let's take a look at an example of the types of questions you might find in a risk tolerance questionnaire. In 5 years, how do you feel that your standard of living will be compared to what it is today? Imagine you've just received a large amount of money. How would you invest it? How optimistic or pessimistic are you about the economy today? When you think of the word risk, which words come to mind first? If you had to choose between more job security but a small pay increase, or less job security but a bigger pay increase, which would you choose? Imagine you're in a job where you could choose to be paid a salary or a commission, or both. What would you select? Assume that a long-lost relative has left you a home. Now, it's in poor condition, and it's probably worth about $300,000 if you sold it right now. The neighborhood it's in is becoming popular. If you were to spend about $100,000 on renovations, the selling price would be around $600,000. However, there is some talk of constructing a highway near the house. That would lower its value considerably. With all of those options, which would you choose? And how much confidence do you have in your ability to make sound financial decisions? Now, if you'd like to stop the recording here for a minute to ponder those questions and your answers a little more, please do so. While we won't actually put a score to this risk tolerance questionnaire, we will say that you can look at some of the choices and see where you might fall. So if you often selected the first choice, then you're likely a little more conservative. However, if you often chose the last choice, then you're likely more aggressive, or you might have felt comfortable somewhere in between. Now, we're all human, and as human investors, it's important that we understand that we have behaviors and emotions and biases that could affect our investment plan. The list of potential biases could go on almost indefinitely, but let's touch on a few of the most common. One is loss aversion. That is having a much greater desire to avoid a risk that could bring about a loss. But as an investor, you could also think about loss as a missed opportunity for gain. Another bias is familiarity. IBM, Google, Verizon, these are all common names that we know. We are familiar with them. And in investing, people may prefer to have stocks in companies that they are familiar with, that they buy services from, perhaps they work for. They feel that they have some kind of connection. However, that bias can cause investors to misread past and future market fluctuations, thinking that they're predictable, that they're safe, and that can result in overconfidence. Anchoring. Think about what happens when you anchor a boat. You might float around a little bit, but you're basically staying in the same place. Anchoring is a bias of a tendency to rely too heavily on or anchor to one piece of information when making a decision. So when we're talking about investments, one anchor might be the share price relative to its trading history. But where that price has been in the past presents you with no information about whether a stock is cheap, expensive, or if it even fits into your investment objective. We want to have a range of well-researched investment opportunities so that we can act on an informed basis when prices start to move. Now, how do some of these biases affect our success in investing? Well, the first is the endowment effect. People tend to value something much more highly once they own it. This is closely related to loss aversion. In one experiment, students were given a mug or a chocolate bar at the beginning of class. At the end of class, they were told they could trade. What happened? Most of the students kept either the mug or the chocolate bar that they were given at the beginning of class, regardless of what their personal choice was. This is a classic example of the endowment effect. Once we receive something, it becomes ours. And once it is ours, letting go of it feels like a loss, even if it might be preferable. For investors, one result of the endowment effect is the refusal to sell a loss-making investments in hopes that they're going to make their money back. And that's almost like sticking with the status quo, which is another result of a bias. This is a preference for the current state of affairs, and we don't want to make any changes due to the risk of loss. For investors, the bias is that the original price becomes the point of reference for that stock, and whether the subsequent sale either locks in the loss or results in a gain. There's a willingness, of course, to sell a stock that has a gain, just as much as there is a willingness to hold on to a stock that has lost value, thinking about the endowment effect. Now, what we don't often think about is that there can be tax advantages to recognizing a loss or holding on to a gain. But the emotional desire to avoid recognizing a loss can result in underperformance. The decision on whether to own a stock simply compares the current price with the expected or potential future price and the dividends. Whether the price is higher or lower than the original price may be irrelevant. And then there's the bandwagon effect. People often value a choice based on a comparison. Think when you're shopping and you see something that's at a discount. We often feel like a purchase is a good deal if we bought it at a discount from a high sticker price, even if that sticker price was actually not related to the selling price. An investor who compares good returns in their own portfolio may be displeased if a friend shares that they're getting greater returns, even though the friend may have a riskier investment and a different risk tolerance profile or objective. But with the bandwagon effect, that doesn't matter because the point of reference changes. So it's important to note that you can control for these emotions and biases through risk management and the steps that we've discussed: allocation, diversification, and rebalancing annually. A financial professional, someone who knows your goals, your risk tolerance, your time horizon, can help you and may be your most valuable asset in any type of market environment. The financial professional can help you create the best possible financial strategy for your long-term goals and help you review your overall investment portfolio at least annually. And as the market changes over time, a financial professional will be right there with you, helping you to make changes as necessary. Now we'll welcome back Christina.
Thank you, ladies, for letting us all know we are worth the risk. If you have any questions regarding this content or would like to speak with one of our advisors regarding the risk tolerance tool, please reach out. Our contact information will be listed on the screen. Also, stay tuned for upcoming seminars. All future events are posted on our website. Remember your 3 Ps: prepare, plan, and partner. On behalf of myself and the whole team, we thank you for joining us today, and we hope to see you soon.